So we got you fund manager who's a very active stock picker. Amit Jeswani of Stallion Asset is now joining us. Amit, afternoon. Tell us, what's your approach been to the markets? Have you been cherry picking? Is your activity decent, or are you mostly sitting on the side looking for a big drawdown like many on the side were expecting, but the market is not obliging with a decent drawdown?
Hi Ajay, good afternoon. Thank you so much for having me on your show. Ajay, we are now fully invested. In fact, I think for our older clients, our cash levels would be less than or near 1%. So we are fully invested. We have not a lot of cash on our portfolios, but we've always been fully invested. Only few, like last quarter, we'd gone on some cash, but for us, cash is not a position. It's an outcome. If we don't get stock ideas, automatically we come on some cash. But for now, we are near fully invested. But we're still hunting for new ideas. Because some of our stocks are overextended, so we don't mind taking some money off and buying some new ideas. But new ideas are very tough to get.
Interesting. You've been bullish on the entire market infrastructure related counters like wealth managers, some of the commodity exchanges. Look at how Nuvama is doing. For example, MCX has come back to fresh lifetime have. In fact, beaten down Angel, which got halved from top, has come back 30-40% in last 2-3 days. Are you continuously liking this space? Have you trimmed exposure? What are your thoughts here?
So broadly, we are about 11% to my memory, or to 11%, around 11% in capital market. We've done extremely well in capital market stocks, but so has been the growth rates. If you see for the wealth management company that we own in our portfolio, growth was 51% in revenues. The commodity exchange that we have grew at 60% plus. When you're the way this game is just getting started, I think wealth management companies, the largest wealth management company in the country makes about 1,000 crores of profits. So this game is very small right now. If you see globally, in India, all AMCs combined make around 9,000 crores of profits. Globally, wealth management is 3 times bigger than asset management industries. And these wealth managers will also become asset managers. If you see, I'm just giving you an example. Stocks are not recommendations. We are a portfolio management company. We aggressively buy, sell stocks every day. And my family have vested interest in virtually whatever I speak, and my clients also have vested interest. So coming to these wealth managers itself will become AMCs, and they'll become very large AMCs because these wealth managers have control over the clients. We also pay these wealth management companies a commission. So, and these commissions are not going to go down easily.
Interesting. Let's move on and talk about wires and cables. That is also, in fact, after having such a great run, wires and cables are again seeing fresh upgrades. Just today, UBS came out with an upgrade on wires and cables. But I have a contention on the valuation part. What is the right way to look at it? 45-50 times forward also are okay, decent to own given the size of the opportunity, or the space is good structurally, but valuations are slightly on the higher side. How would you approach that space?
So the way to play power, if you see the generators, like I'm just giving an example, like Tata Power and all these kind of guys, JSW Energy, their ROCs are 12-13%. Then you have the Siemens, etc., who is part of that power equipment trade where valuations are 80 times, 90 times FY25. And then you have wires and cables, which are at 45 times. So when you do relative and power is going to, people say, and people are hyper bullish on power, that power will be used in cars, in data centers, so your internet, your normal power consumption in India grows at 7%. So broadly, there'll be a 10-15% growth in power, in cable demand in India, but the game is exports. Anyone right now, anyone who gets it right in the exports market, because like US alone is a $50 billion wire and cable importer kind of a market where China is very dominant and India is just getting started. Only APAR and small sums of Polycab sells their wires and cables. But I agree to your part that we've also gone, we used to have 8-9% allocations in, let's say, wires and cables. Right now, if valuations change, you change your allocations also. Now our allocations are a lot lesser. Now we're at probably 6%. If valuation, so you make your position sizing based on expected risk reward and alternate opportunities which are available to you. So right now, for us, the wire and cable company is 6.5% allocation. So we keep moving up and down. If today this wire and cable companies comes down by 20%, we might take it back to 8%. If it goes up 20%, we might come down to 4%. So for us, we are just finding opportunities and decreasing our allocations based on our expectations of risk reward and alternates.
Point. Amit, I'm sure you must have observed in the last 2-3 months, one of the largest aviation companies has given out very interesting commentary. They are going wide body. They are going from affordable low cost to now international, and that to full service. How did you see that commentary coming in? In fact, went on their 18th anniversary recently. The CEO went on to say that we will be adding one new route of flight almost every month. What are your thoughts on the aviation play, both via the aviation company as well as via airports, perhaps?
So airports is I don't know how to calculate ROCs out there, because this is very long gestation period and a very tough business. But aviation is a negative working capital cycle business. I think an analyst out there, not me, the analyst out there believes that the largest market leader of airlines in India, who has 62% market share, will do profits of around 10,000 crores. And the analyst also believes that for number 2 player, which is the Tata Group, for them to break even in the aviation industry, like the market leader will have to make about 20,000 crores of profits. So basically, that is the cost structure difference. If you see ICRA's report for FY24 on aviation, even though the market leader made 8,000 crores of profits, the entire industry made 2,000 crores of losses. Basically, the other players lost 10,000 crores. So basically, here the only problem is promoter sale. And if promoter sale keeps coming, your PE ratio, which is at around 20 times right now, for a market leader with 15% plus growth rates for next 10-15 years. Dominant player. If you see, with lower growth rates, a player which is the market leader in cigarettes in India, ITC, gets 30 PE multiple. With lower growth rates, market leader in technology services, which is TCS, with 5-7%. See, valuations are largely dependent on opportunity size, growth, and ROCs. So there'll be unlimited ROCs in Indigo also. This is what I think. And they will start paying out dividends, because these businesses don't need money to grow. All these airlines are on lease. The new airlines that they keep buying, these are on long-term lease, like 20-year leases. So the profit you generate is actually is free cash flows. And these companies will start paying. Indigo just went to positive net worth. This is not a recommendation, of course. We have vested interest. But right now, they'll start paying off 50-70% as dividends. So this will become some point a dividend stock. But promoters are selling here. That is the negative. But they've been selling from $1,800.
Sure. Amit, what else are you researching and studying right now as part of looking for alpha generation?
We want long-term, secular, sustainable growth in consumer-facing companies. And wherever we find that, we bought this quarter a music company, which is growing at 30-40%, but the stocks moved up 20%, 30%. But our philosophy is the same. In my industries, in every industry, we divide India in 71 industries. I want the best performing company in every industry. And initially, when we buy, we want to buy it at low valuations, and then we ride it till the time earnings growth is there. And like if you see the fashion retailer that we have in our portfolio, the growth was 57% this quarter. If you saw the food delivery company that we have, growth is 74%. 74% is the growth in a food delivery industry, where if you look at QSR companies, the growth is less than 10% for all of them. So there is disruption which is happening in front of our eyes. And we can go wrong. We can cut our positions any point of time. But for now, that is our portfolio. We are in those disruptors, high growth, high ROC, market leaders. And we are finding alternates. It's not like we are not finding alternates, but there is nothing to move out. Like if I sell my good performers, where do I move my money to? There are not many scalers. This earnings season was a horror show. So we are not getting opportunities for us to pivot from our existing companies to better companies, because there are not, according to us, we are not able to find better companies.
Sure. Amit, I want to talk about a little more about the tier 2, tier 3 India. You have a consumer durable retailer from that space. When we speak to a lot of retailers in the bottom end of the K, one is getting a sense that things are turning around after 2-3 years. What are your thoughts on this? Or would you like to remain? Because you've got both the ends. You've got premium representation as well on your portfolio, and tier 2, tier 3 consumer durable retailer as well. What's your view on the bottom end of the K?
So I personally think places like UP, Bihar, Jharkhand, the retailer that I think that you're speaking about, that we have in our portfolio, these consumer durable like electronics, it's going to be a very large play in India. If you see, we've got the largest mobile manufacturing also, one of the largest AC manufacturing company also we have, and the third play that we have is one Bihar-based retailer also. So that is how we have the electronics basket in our portfolio. And I fundamentally believe the growth should be 25-30% in all these companies for a very long period of time. I think as this is what China's history says, that post $2,500 per capita, China saw 3x GDP growth in consumer durables. And that point is coming in India. It's a red ocean out there. So you want monopoly. Like AC companies, there are 25 AC companies. But manufacturing companies, there are only 2-3. So I want to be with the manufacturers, not with that brand this thing. Retailers in every region, like in Bombay, we have Vijay Sales and Chroma and Reliance. These are the only three, or Kohinoor, 3-4 retailers. Same way in retailers in every district, there'll be 3-4 retailers, and I want to be with the best retailer, best performing. If you see by retail, Trent was number 1, of course, but number 2 company also we have in our portfolio. Third is your manufacturing retailer, and in manufacturing mobile also we have the number 1. There is a complete blue ocean in mobile manufacturing in India. There were 5 players who got PLI for mobile phones: Micromax, Lava, Dixon, Carbon, and one more listed player, I'm forgetting the name. But these 5 players, 4 have not been able to get PLI only. And the Dixon is just nailing it. So we like, we want the best executor. And people think that we've always made money in buying good companies. And a lot of people will say that, valuations are so high. I'm not defending any valuations because we ourselves keep moving from one stock to another. But we think that more money has been lost in buying bad companies at cheap prices than buying good companies at little bit expensive prices. But I myself, I'm a value investor, so I buy good companies. That is first criteria, but at reasonable valuations initially.
All right, Amit, we'll let you go on that one. Thanks so much for joining us on the show today.
Thank you.
That was Amit Jeswani of Stallion Asset.
If you like this video, then like, share and subscribe to ET Now.